If you're planning to retire in the next 5 years, there's one number I want you to see before you do: 1.3% annually. That's actually the projected annualized total return, including dividends, that we are looking at for the stock market over the next decade, based upon the model I'm going to show you. And if you factor in no dividends, we're talking negative 0.7% per year for a decade. Now, I want you to think about your retirement plan for a moment. What return are you counting on? Is it 6%? Is it 8%? Is it maybe even more than that? Because if you're getting ready to retire and your plan needs 6, 8, or 10% from the market to work, and then all of a sudden the market gives you 1.3%, we have a problem. And that's why I've become increasingly concerned that we could be setting ourselves up for another lost decade. Now, if you're 35 or 40, that's going to be painful. But if you're 60, 62, 65, and about to retire, that's an entirely different situation. You're in what we would call the retirement red zone. And I want to show you exactly why I'm concerned. Let's start with Robert Shiller. Shiller is a Nobel Prize winning economist, and one of the valuation measurements he's known for is the Shiller-CAPE ratio. Without turning this into an economics class, CAPE essentially compares stock prices with inflation-adjusted corporate earnings over a 10-year period. Here's the numbers that matter. We're sitting at approximately 42. The historical average is around 17, and one of the highest readings we've ever seen is approximately 44 in December of 1999, right before the dot-com bubble burst. We're knocking on the door. Now, think about what happened right after 1999. The dot-com bubble exploded. We eventually recovered after years, but then came the financial crisis. And that period became known as the lost decade. 10 years of negative returns in the market. That's why I'm paying attention to this. Now, am I telling you that CAPE predicts that the market crashes next Tuesday? No, that's not how it works. It can't tell me exactly when the market turns, but historically there's been an inverse relationship between CAPE valuations and subsequent long-term returns. In plain English, when you pay an extremely high price for stocks, future returns can become much harder to come by. And that's where I get back to the numbers I gave you at the beginning. We're looking at approximately 1.3% annualized total return over the next decade, including dividends. And on a price return basis, approximately negative 0.7% a year. Now, maybe you're sitting there thinking, Andrew, 1.3% doesn't sound good, but is it really that catastrophic? Well, it depends. How old are you? Because this is where the story really changes. If you're 40 years old and still working, you have something incredibly valuable on your side: time. You're still getting a paycheck, you're still contributing to your retirement accounts, the market falls, you keep buying, you've potentially got another 20 or even 25 years before you're living on this money. But what happens when you retire? Everything reverses. You spent 30 to 40 years putting money into these accounts, and now you're gonna start taking money out. And that's why I keep talking about the retirement red zone. Because the years immediately before and after retirement can be some of the most important years of your entire financial life. Let me show you why. Say you retire with $1 million. You're feeling pretty good. Then 6 months later, the market drops 20%. You're not just looking at a bad statement anymore. You need income. You need groceries. You've got property taxes. Maybe you're traveling. Maybe you're helping the kids or grandkids. Whatever your retirement looks like, life is still happening. So you start selling investments to create income while those investments are down. And every share you sell is a share that isn't there when the market eventually recovers. That's called sequence of returns risk. And this is one of the things I think people underestimate the most before retirement. You could have two people retire with the same amount of money. They could spend the same amount per year. They could even experience the same average investment return over the course of their retirement. But if one person gets the bad years at the beginning and the other person gets those bad years later, they can end up in dramatically different places. Same average return, just a different order, which leads to a different retirement. That's why I don't think 1.3% is actually the scariest number we're talking about today. The scariest part is when those returns could show up. Because if we do get another lost decade, a decade that averages averages a negative return overall, and you're entering retirement right now, that lost decade could be the first decade of your retirement. And now we've got a very different problem. Valuations aren't the only thing I'm watching. Here's something else that actually has my attention right now. Historically, we've seen a bear market, which is a decline of 20% or more, roughly every 4.5 to 5 years. If you go back to the late 1920s, we've seen close to 27 distinct bear market cycles. Our last bear market was in 2022. Now, before somebody takes it out of context, I'm not saying the market's going to crash because it's been 4 years. The market doesn't know what year it is. I'm simply saying that another bear market at this point would not be historically unusual. And when I combine that with valuations around 42, according to that CAPE ratio, I pay attention. But there's something else happening that I think investors should be watching. South Korea. Look at what happened with the Kospi. You had enormous enthusiasm surrounding artificial intelligence and semiconductor companies. You had retail investors using substantial leverage and margin debt. Everything looks wonderful when the market's going up. And then the direction changes and leverage starts working the other way. Margin calls hit, investors are forced to sell, and that selling creates more pressure. More pressure creates more forced selling, and suddenly everybody is trying to get through the same door at the same time. Some of Korea's largest technology companies were right in the middle of it. In fact, the South Korean stock market had the single worst month drop in Korean stock market history. In July of 2026, the market had dropped 33% alone in just 1 month. 3% of the entire population of South Korea was margin called. South Korea is going through at least a recession, if not worse. Now, does that mean because Korea had a problem that the United States is automatically next? Of course not. That's not what I'm saying. I'm showing you what can happen when you combine three things: enormous expectations, crowded trades, and leverage. And when I look at what's happening here in the United States with AI, I'm paying attention. Now, don't misunderstand me. There are some phenomenal companies involved in AI. Phenomenal. But I've said this for years. A great company can still be a terrible investment if you pay too much for it. Price really matters. At a CAPE ratio of approximately 42, we're paying more than twice the historical average valuation we're talking about. That doesn't mean that these companies are bad, it just means expectations are probably too high. And when expectations are that high, a lot has to go right. Then we've got another problem developing halfway around the world: the Gulf. The conflict involving Iran and the Gulf has disrupted the movement of important commodities and materials. And we've got the Strait of Hormuz sitting right in the middle of one of the most important energy routes on the planet. You might be wondering, what in the world does Iran have to do with my 401k? Well, potentially quite a bit, because the technology economy doesn't exist in some imaginary digital cloud. These companies have to build things. AI requires data centers. Data centers require enormous amounts of energy. Manufacturers need components. Companies need functioning supply chains. Raw materials have to move around the world. So when you start disrupting energy, commodities, shipping, and supply chains, those costs can eventually show up somewhere. Businesses will feel them, consumers feel them, inflation can feel them, and the markets can feel them. And eventually, your retirement account will fill them. So here's what I'm looking at. A CAPE ratio around 42 versus a historical average around 17. A previous extreme, the worst in over 100 years, only topped at 44 right before the dot-com era. A projected annualized total return around 1.3% over the next decade, and a negative 0.7% on a price return basis over the next decade. We're several years removed from the last bear market. We've watched leverage and AI enthusiasm create enormous volatility in Korea. We've got geopolitical and supply chain risk coming out of the Gulf, and I believe there's a real possibility that we're headed towards a recession in the coming months. I've said on the radio, I believe the Trump administration is trying to hold this economy together with popsicle sticks and bubblegum so that he can get through the November elections. Now, that's my opinion. Maybe I'm right, maybe I'm wrong, but here's the part I really want you to hear. I don't want your retirement to depend on whether I'm right. That's the point. Because some of you are probably thinking, well, Andrew, if you're this concerned, are you telling me to get out of the stock market? Not necessarily. I don't want you walking away from the video thinking, get out of the stock market today, because going completely to cash based on somebody's market prediction can create an entirely different set of problems. What if I'm wrong? What if the market keeps going up? Now you're sitting on the sidelines. Inflation's eating away at your purchasing power. You might be missing some growth. And then you've got another impossible decision. When do you get back in? I'm not interested in helping you guess or time the market. That's impossible. I'm interested in helping you prepare your retirement for a market we cannot guess. That's a completely different philosophy. So if you're in that retirement red zone, 5 years before retirement, 5 years after, here's what I want you to do. I want you to answer 4 questions. And don't just answer them in your head. Pull out your retirement plan and look. Number 1, what rate of return does your retirement plan assume? Most advisors will assume 6, 8, even 10%. Whatever that number is, ask yourself, what happens to my retirement plan if I only get 1.3% over the next decade? Does my retirement still work? Or does the entire plan start falling apart? Number 2, if the market falls 20% during my first year of retirement, where does my income come from? That's a huge question, because I'll just sell investments sounds fine until those investments are down 20, 30, even 40% or more. I want to know where the paycheck comes from before that happens. Number 3, how much market risk do I actually need? Notice I didn't ask how much risk you can tolerate. I asked how much you need. Those are different questions. If you can accomplish your retirement goals without taking enormous amounts of market risk, why would you take more risk than necessary? And number 4, what jobs are your different assets supposed to do? What is there for growth? What creates income? Where is your liquidity? Where is your protection? Now, I'm not telling you there's some magical product that solves every one of these problems. There isn't. I'm also not telling you that everybody watching this should have the same retirement strategy. That's nonsense. You've got different assets, different Social Security benefits, different tax situations, different spouses, goals, spending, and different lives. Your retirement plan should reflect your retirement. But I do believe in one principle very strongly. Your retirement should not require a perfect stock market to work. Think about that again in your head. Your retirement should not require a perfect stock market to work, because you don't get to pick the decade you're retiring into. And if you're 2, 3, 4, 5 years away from retirement, you have an advantage right now that you may not appreciate. You still have options. You're still getting a paycheck. You can make adjustments. You can figure out where your retirement income is going to come from. You can coordinate Social Security. You can look at taxes. You can decide how much risk you actually need. You can build liquidity. You can stress test the plan. You can make those decisions while everything is calm. Because I promise you, the worst time to discover you have too much risk is after the market takes the money. And the worst time to invent your retirement income strategy is after the paycheck stops. That's what the retirement red zone is all about, preparing for the transition before the transition happens. So let's finish where we started, 1.3%. Maybe that projection turns out to be wrong, or maybe we have another phenomenal decade in the stock market. Wonderful. I'll happily be wrong with Shiller, but what if he's right? What if I'm right? What if we get another lost decade? What if the market gives you nowhere near the returns you've built into your retirement plan? What if the first bear market hits 6 months after you retire? I want you to know the answer to this question before any of that happens. Does my retirement still work? If you know the answer, fantastic. If you don't, use the link below and schedule a 15-minute conversation with our team. We'll talk about your retirement, where your income is supposed to come from, the risk you're taking, your Social Security, your goals, dreams, desires, concerns, and objectives for retirement, and whether the strategy you've built is actually prepared for more than one possible future. I'm not going to promise you I can predict the next 10 years. No one really can. But I do believe we can do a much better job preparing you for them. You spent 30 or even 40 years getting to retirement. Before you turn off that paycheck, let's make sure your retirement isn't depending on the stock market giving you exactly what you were hoping for.